Good morning, students. Today also we will continue the chapter company accounts, and the topic today we'll discuss is shares. Okay. So yesterday in the previous class we discussed what company introduction and the definitions, types of companies we discussed. Okay. So today also we'll discuss some of the theory parts, so which will help you to understand about the concept what shares. Okay. So first we think what do you mean by shares. So last year in when you were in 11th class you studied actually company and types of shares and all. So once again to remind you, just we'll go through those what topics. So first we'll see the meaning of shares. Okay. So we know that there are different forms of business organizations: sole proprietorship, partnership, companies. Companies are known as what? Joint stock companies. So all these are different forms of organization formed for doing different types of business. So all forms got its own merits and demerits. So sole proprietorship and partnership we studied, and we know that the merits, demerits, everything. So company, when we hear about company, company is a large form of business. There means we need more capital, more money will be invested, huge capital investment, more number of employees, large scale production, then large turnover, then of course the profit also will be very high, and its area of operation will be very wide. So company means like that. So company can be formed in different way: private company, public company, unlimited company, so many types, one person company types, everything we discussed. Okay. So for these all companies, sole proprietorship means who invest money, the owner invest the money. Partnership, in partnership business, who invest the money, partners invest the money. But in company form of business, who invest the money? The public. So public companies, for the public companies, public can invest money. So that is why it is called what? Share. So here the total capital, suppose total capital of the company is divided into units of small denominations. Each small unit is called what? Share. So the total capital, we can decide the total capital. How much capital is required? Means how much money to be invested for running the business, that can be decided in advance, and we can decide how much to be issued to public, how much from relatives, how much from friends, like that. So share means that only. Suppose I am investing, I'm starting a company and I am saying I'll invest 5 lakh. So 5 lakh is my share. Okay. So another person investing 2 lakh. So 2 lakh is his share. So suppose this is amount, means we have to divide it by the face value of share, one share price. So one share 10 means how many number of shares are there. Okay. So the total capital of the company is 10 lakh, example, divided into 1 lakh units. So we are saying that 10 lakh money needed. This is the total capital required. 10 lakh. This is in rupees. Okay. So now this 10 lakh rupees is divided into 1 lakh units. You are dividing it into 1 lakh. So you can say this is the number of shares. 1 lakh shares. Okay. This is shares of rupees 10 each. So 1 lakh means one share will be how much? 10. So 1 lakh into 10 will be 10 lakh. So how much you need? 10 lakh rupee you want. So for that, how many number of shares you have to issue? If one share is 10 into 10. Okay. If one share price is 100, then how many number of shares you have to issue? If it is 100, how many shares needed? 10,000. Correct. So when the face value increase, number of shares will decrease. 100. So you need 10 lakh. Understood? So in this example, actually 1 lakh shares of 10 each. So total is 1 lakh is the number of shares. 1 lakh into 10. So this 1 lakh is called what? Unit or share. Each share, each unit is 1 lakh. of rupees 1 unit price is 10. So this is the face value, or we say nominal value, face value or nominal value. So this 10 lakh is the total capital. Okay. So this only share means that only. So how many number? Suppose I come to a notice that I want to purchase 1 lakh units. I cannot purchase 1 lakh. How much money I have, I can purchase. Suppose I want to purchase 5,000 units, then 5,000 into how much I have to pay? 10. Okay, so it is 50,000. This is very easy. Actually, one share price means, suppose you are going to shop and the shop owner is telling 1 pen rupees 10. Then if you are purchasing 5 pen, then 5 pen is equal to how much? 10 into 5, like that only. So number of shares into the unit price you have to multiply. So you will get the total capital. So this one. Okay. So many people will purchase. Some may purchase 5,000, some may 10,000, 1,000, 200, 100, like that. No, from this 1 lakh, different denominations people purchase the shares and they send the money to the company. So company's bank account will be there. So in bank account, shareholders send their money and one last date will be there. After the last date, they will collect and see that how much received, and they will, as per the rule, if it is not received again, they will wait. That and all we will study later. Okay. So these things. Now nature of shares we'll see. So shares means it's a movable property. If you are a shareholder of a company, you can transfer it to anywhere, transferable in a manner provided by articles of association. So what articles of association is saying, in the same way, as per the rules written in the articles of association, we can transfer it. Okay. So we can say it is movable property, and share of a company is treated as goods. So it is equal to goods. When you purchase goods something, you are paying money and getting something. So just like that, you are paying money and you become shareholder. But share is not a physical property. You cannot see any physical things there. It is just a paper. Okay. Now it is in electronic form. On through online only people are interacting or buying and selling shares. Okay. So under Sale of Goods Act 1930, this share is treated as goods. This can be bought, sold, hypothecated, and bequeathed. Bequeathed means this can be, we can purchase it, sell it. Hypothecate means we can give us a pledge in bank. Suppose you want to take loan, you can submit your share certificate to bank and take loan. That is hypothecation. Okay. Then bequeathed means, as a will. Suppose you are you have a daughters or son, and if you want to, at your own will, you want to transfer this share to that person, you can transfer it. Okay. At the will of a person, that is this one. Okay. So this is the nature of shares. Now types of shares we'll discuss. Under section 43 of the Companies Act 2013, a company can issue two types of shares. So mainly two types of shares are there under section 43 of Companies Act 2013. The original Companies Act in the year 1956. Okay. Now this new act, Amendment Act, is in the year 2013. So there are two types of shares: preference shares and equity shares. This we studied last year. Even then, once again, we'll go through just the types. So preference shares. So what do you mean by preference shares? Preference. They are getting something preference. So what is the preference? So first preference is right to receive dividend at a fixed rate. These preference shareholders, usually we say 6% preference share. One rate will be there, or 5% preference share, 4% preference share, 10% preference share. Like that, one percentage will be there in front of the name of that particular share. Okay. So suppose it is 6% preference share means this 6% is the dividend rate. Okay. 10% preference share means 10% is the dividend rate. This dividend is fixed. Okay. 6 means out of 100 rupee, if company is earning profit of rupees 100, 6 rupee they will get. Clear? like that. So fixed rate before any dividend is paid to equity shareholders, so they are getting it first, means before paying to equity shareholders. Another category of shareholders are what? Equity shareholders. So normally equity shareholders are the pure owners of the company. Okay, so these preference shareholders also owners only, but they are getting some preference over the equity shareholders. So what are the preference? They'll be getting dividend before the payment to equity shareholders. Means suppose 100 rupee profit is there, 6 rupee will pay to preference shareholders, remaining 94 rupees. Out of that 94, if the company has loan anything, we will pay that also. Suppose 10 rupee loan. Okay, so 10 goes to loan. So now how much gone? 16 rupees gone. Okay, and now 4 rupee gone to any other creditors, payment is due, so we have paid that also. Now 20 rupee total gone. Now how much is remaining? 80. So this 80 only, 80 also we will think what, 20 rupee we retain in the business, remaining 60 rupee only we can declare as dividend to the equity shareholders. So actually the real profit is 100, so the equity shareholders are getting only 60, the share out of 60 only. They will not get out of 100. Understood? So that is the difference. So this is there when equity shareholders and preference shareholders are there. So company can decide whether to include equity shareholders and preference shareholders or not, creditors or not. That and all company can decide, because whenever more number of preference shareholders, another thing is there, debenture, that is also we studied, is there, then it will affect the credit, what, um, credit worthiness of the company. So right to return the capital at the time of winding up of the company before that of equity shares. So next preference is they'll get the capital also first when at the time of winding up. So just like a dissolution chapter we discussed, so dissolution of a partnership firm we discussed, you know. So there also we studied, first we have to pay to outsiders, then loan amount will pay, then capital amount, like that particular order is there. So here also these preference shareholders will be getting their amount first. Okay, so after making payment to them, the remaining amount only will be shared among who, or will be given to the equity shareholders. So two rights are there. Just remember simply, right to get dividend, right to get the principal amount at the time of winding up. Okay, two rights. Now types of preference shares we discuss. So there are so many types of preference shares. So each category, cumulative, first is cumulative preference share. So what do you mean by cumulative preference share? If any year the profit of the company is insufficient to pay the dividend, it will be keeps on accumulating until it is fully paid. Yeah, cumulative means suppose this year dividend, this year loss, we didn't pay dividend, so next year we will pay. Then next year also we didn't pay, then that amount also will be added and will be paid afterwards. So any year pending dividend is there, that will be paid, accumulated cumulative frequency and all, you know, no. So 2, this year 2, next year 4, next year 8. So cumulative, what we can say, 2 plus 4, 2 plus 4 6, then 6 plus 8 14. So like that it will accumulate, so this 14 they will be getting. Okay, then non-cumulative, next type. Non-cumulative means opposite of cumulative. Any year no profit, no dividend, then they will not be getting next year. Next year profit only they'll be getting, the previous year dividend they will not get. So if the previous year insufficient profit and the partners, or sorry, the shareholders will be getting it afterwards, then it is cumulative preference shares. If they will not get it, then it is non-cumulative. Okay, this last year also we studied. If you have a business studies textbook, just you can see that. Okay, then next is participating, non-participating. So what is participating? Participating means in addition to fixed dividend, they can participate in the surplus profit of the company. So fixed dividend we said, no, preference shareholders have fixed dividend. Example I told you 6%. So in addition to this 6%, sometimes they may be getting some additional dividend also if the company is earning more profit, surplus profit. So sometimes company earn more profit if the situations are good, economic conditions are good, then the company will earn more profit. So surplus profit they also will be getting. Which category? Participating preference share. That if you are a participating preference share category of shareholder, then only you will get, otherwise you will not get. Okay, then non-participating means, yes, that shareholder is not participating in the surplus profit. So here participation in what? Surplus profit of the company. Understood? So participating preference share means the shareholders have the right to participate in the surplus profit of the company in addition to the fixed dividend. Okay, but non-participating means they have no right to participate in the surplus profit. Whatever fixed is there, that only they will get. Next is redeemable, irredeemable. Next type. So redeemable. Redeem means repay, repayment. Okay. So redeemable, irredeemable. This will be redeemable means this will be repaid by the company within a stipulated period in accordance with the terms of issue and under certain conditions in section 55 of the Companies Act 2013. So redeemable means suppose through preference share issue company collected 5 lakh rupees. Okay, so this 5 lakh we collected for 5 years. That means we told them this money will be paid back after 5 years. So that if that condition is there, then it is called what? Redeemable. We are repaying it with in advance. We told them what this is redeemable and will your amount will be repaid after 5 years. Understood? So till 5 years they'll be getting dividend, only dividend, but at the end of 5 year they will get their principal amount 5 lakh rupee also they get back. Understood? So that is called what? Redeemable. So irredeemable means opposite. The capital of these shareholders will be repaid only at the time of winding up of the company. So after 5 years, 10 years, that condition will not be there when they get back the money at the time of winding up or liquidation or closing of the company. That time only they will get the money back. Okay, so redeemable means they have the right to get their capital according to the terms and conditions of issue. So issue time. Now suppose I am borrowing money from you 1 lakh rupees and I am saying you that I'll give you back after 2 years. Then that is redeemable. I'm giving you the condition. When you gave me money 2 years before, you are giving the condition. Okay. So that is redeemable and irredeemable. Next is convertible and non-convertible. Okay. So convertible means the holders of these shares have the right to convert it into equity shares. So when we can convert preference share into equity share, that is called what? Convertible preference share. It is easy. So now the shareholder is preference shareholder. He wants to become the owner and ready to take risk. Then he can become equity shareholder. So that a conversion is possible in convertible preference shares. Then non-convertible preference shares. Non-convertible means when the holders have no right to convert it into equity shares. Okay, they cannot convert it into equity shares. Such shares are called non-convertible preference shares. Okay, so these are the different types of shares. Okay, so what are the types? Cumulative, non-cumulative, participating, non-participating, redeemable, irredeemable, converting, non-convertible, convertible, non-convertible. Now second category is equity shares. So what do you mean by equity shares? Equity shareholders dividend is paid after making payment to the preference shareholders. So first itself I told you preference shareholders are getting are the right to get the dividend first. Afterwards who will get? Equity shareholders will get. There will be no fixed rate of dividend for equity share. Yeah, equity shareholders have no fixed rate. If more profit they will get more dividend. If it is less profit they get less dividend. Okay, only preference shareholders have a fixed rate. If any year no profit they will receive nothing. So if loss they have to suffer it. They will not get anything. They will not They should not tell anything. If the company earns higher profit, they get higher rate of dividend. Understood? No. If no profit, nothing they will get. If a higher profit, then they will get everything. Higher rate of dividend. They have voting rights and control in the affairs of the company. This is main. So mainly the affairs and control, company decision makings and all through voting. Okay, so majority, how many people votes? Last year also in class we did, no? So who votes more, so like that, no, they have the voting rights. Through votes they can decide on so many things about the management of the company. Their capital is repaid only when preference share capital is paid in full. Yes, so first who will get capital back? Preference shareholders. After that only who will get? Equity shareholders will get. Okay, so these are the features of equity shareholders. So their dividend will be paid after preference shareholder, their capital will be paid after preference shareholder, and then there will be no fixed rate of dividend. If no profit, no dividend. If higher profit, then high rate of dividend they will get. They have voting rights and the control over the affairs of the company. Okay, so this much only. And actually these are theory parts just to know about the shares and its nature and all. But we have to study the accounting treatment. Problem part is different. Okay, so just for your knowledge I explained all these things. Then next class we will discuss the share capital and its division, how to calculate it and all, no, that we will discuss in the next class. Okay, so today this much only. Thank you so much. Bye, take care.